If you glanced at the news today, you'd probably see all these headlines, right? Record stock market highs, amazing AI stuff, officials saying, don't worry, the economy's fine.
Yeah, it definitely sounds like smooth sailing on the surface.
Exactly. But that is the surface. So our job today is to look past all that noise, past the fanfare, and really zero in on the underlying data points, the cracks, maybe, the structural weaknesses that, let's be honest, economists and central bankers don't often shout about. We've pulled together source material looking at this convergence of different crises happening all at once. And the suggestion is the whole system is stretched, maybe near its breaking point.
And what's really striking, I think, is that the question isn't really if there's going to be volatility ahead.
Right.
It's more about whether you, listening now, will recognize the specific warning signs, the things showing up in the data we've got before the wider market reacts. Because history tells us these big shifts, they aren't driven by some sudden announcement. It's usually just simple, kind of brutal mathematics catching up.
Okay, let's unpack this then. And I guess we have to start at the foundation, don't we? This accelerating mountain of national debt, the U.S. gross national debt. It's blown past $38 trillion now.
It's such a massive number, it almost feels unreal, hard to grasp. So maybe let's try to put it in perspective.
Please.
That $38 trillion, it works out to roughly $111,000 of debt for every single person in the country. Every man, woman, and child.
$111,000 each.
Yeah. And what's really quite frightening is the speed, the pace we're adding to it.
Okay, look at this specific point from our sources. We added, get this, $1 trillion to the national debt in just 2 months.
2 months.
2 months.
Yeah.
The rate we're piling it on has literally doubled since the year 2000. And this isn't because we're, building amazing new things everywhere. It's systemic, isn't it?
It absolutely is. It's baked in. You've got the runaway costs of mandatory spending, Social Security, Medicare, the things that run on autopilot. Combine that with huge defense budgets, and the economic growth just isn't keeping pace. So the economy is basically borrowing heavily just to stay afloat.
And all that borrowing, it leads right to the fragility you mentioned, the interest burden. This debt isn't some abstract future problem anymore.
No, it's a massive present-day expense. Right now, the annual interest payments alone on the debt are costing over $1 trillion per year.
$1 trillion just servicing the debt.
Just the interest, yeah. And that's, 17% of all federal spending? Think about that. Money going to creditors for past borrowing, not investing in the future.
And the projections. Where does it go from here?
Well, that's where it really looks like a structural crisis brewing. These interest payments, they're projected to just balloon. We're talking $14 trillion over the next decade.
$14 trillion, just in interest payments over 10 years.
Yeah. Just pause on that number. $14 trillion. It's bigger than the entire annual economic output of most major countries around the world.
So, when a government is spending more just paying interest on old debt than on, almost anything else productive, what does that actually mean?
Yeah.
Practically speaking.
That's really the definition of sovereign insolvency. It's a key idea. Imagine a family spending more on their credit card minimum payments than on rent, food, everything else combined.
We're broke. Functionally.
Exactly. Functionally insolvent. For a country, it means the government's main job basically becomes servicing debt. It sucks up all the available capital that should be going into productive stuff, investment, research, infrastructure. You're starving the future to pay for the past.
Okay. So that's the foundation, and it sounds like it's crumbling under its own weight. Now let's look up at the spectacular building sitting on top of it all, the stock market. Our sources describe it as detached from reality, operating in a financial fantasy land.
Yeah, I think the best way to gauge that sort of objectively is to compare the total value of all U.S. stocks to the size of the actual economy, the gross domestic product, or GDP.
Right, the market cap to GDP ratio.
Exactly. And right now, that ratio has spiked to, a historically extreme level, 363% of GDP.
363%. That sounds incredibly high. How does that stack up historically? Are there comparisons?
Well, think about the most famous bubble in recent memory, the dot-com mania back in 2000.
Sure.
At the absolute peak of that frenzy, the market cap to GDP ratio hit 212%. So Today's market isn't just a little stretch.
No.
It's in uncharted territory, almost 70% higher than the peak that led to the dot-com crash. It's, yeah, historically extreme is the right way to put it.
And this huge valuation, it's not spread evenly, is it? It's incredibly concentrated. The data we have shows AI and tech stocks driving almost everything.
That's right. They account for something like 75% of the market's returns and maybe 90% of the growth in capital spending since this whole AI thing really took off.
So it's all riding on tech, specifically AI.
And that concentration, it points to something we see in the late stages of almost every bubble. Speculation kind of takes over from actual analysis.
Hope over reason.
Pretty much. The whole market feels like this giant bet on one narrative, the singularity story, this idea that a few AI companies are just going to become these trillion-dollar monopolies that somehow defy economic gravity forever.
But hang on, isn't there always a compelling story during a bubble? The whole "this time it's different" argument. I mean, could the AI productivity gains actually justify these valuations, like a median price-to-sales ratio of 25 for these companies?
That's the critical question, isn't it? And that PS ratio of 25, well, it's significantly higher than even the dot-com peak, which hit 18.
Higher than the dot-com peak.
Yes. So what that suggests is the current price hasn't just factored in huge success for these companies. It's factored in like guaranteed, limitless global domination. It feels like hope has completely replaced rational expectation. And that, historically, is the final stage, right before the bubble bursts, and that hope just evaporates.
Okay, let's pull back then from the financial fantasy, as you called it, and look underneath the real economy, where the average person, where you listening, actually feel the effects most directly. The sources definitely point to some undeniable strain showing up there.
Yeah, the consumer is, the engine of the U.S. economy,
Okay.
up 70% of it. And the data suggests that engine is starting to sputter a bit.
How so?
Well, Bank of America, they track spending across like 60 million customer accounts, real data. And they're reporting that consumer spending growth has basically been cut in half compared to last year.
Cut in half. Wow.
People are definitely pulling back, tightening their belts. And it looks like they're increasingly having to dip into savings or reserves just to get by.
And we see that caution maybe turning into actual distress in the debt numbers too, right? Consumer debt is just surging. Credit card debt is now well over $1.1 trillion.
It is. And what's maybe even more alarming than the total amount is the quality of that debt. Meaning, delinquency rates, people falling behind on payments, are rising pretty sharply, especially on credit cards and auto loans. And it's hitting younger folks and lower-income households the hardest.
So the cushion people got from, say, the pandemic stimulus, that's gone now.
Completely gone, it seems. Millions are now basically forced to use expensive credit cards just to cover essentials. And when a huge chunk of the population has to cut back spending all at the same time, well, a broad economic slowdown becomes almost inevitable.
And the job market, that's always held up as the source of strength, the resilience. But there are cracks appearing there too.
There are. We only added about 73,000 jobs in the last report for July, which was pretty weak on its own. But the really crucial bit, the thing that maybe got overlooked, was the revision to the previous month's numbers.
The revisions. They always seem to tell the real story later on.
Don't they just? The Bureau of Labor Statistics revised its earlier estimates down by 250,000 jobs. 258,000, I think it was.
Wow, so the weakness wasn't just July.
Exactly. That revision tells us the slowdown wasn't sudden. It had actually been building for months, but it was sort of hidden by the earlier overly optimistic reports. And now the unemployment rate is ticking up too, 4.2%. So that foundation of strength, the labor market, it's clearly weakening.
Okay, so you have consumer strain, weakening jobs. These problems don't exist in a vacuum, do they? They lead us straight into this idea of the policy trap, this sort of impossible choice facing the Federal Reserve.
Yeah, the Fed is really caught, isn't it? It's like a financial game of chicken they can't win. On one hand, you've got inflation still creeping higher, consumer prices up 3% annually, energy jumped over 4% in just 1 month.
Right, so normally they'd raise interest rates to fight that inflation.
Logically, yes. That's the textbook move. But, and it's a huge but, if they raise rates significantly now, with $38 trillion in national debt.
It blows up the government's interest payments. That $1 trillion a year we talked about?
Exactly. Higher rates push those payments even higher, potentially much higher. It accelerates that whole sovereign insolvency problem we discussed, makes it potentially catastrophic very quickly.
So what's the alternative? Don't raise rates.
Well, then you risk letting inflation run hotter, eroding people's purchasing power even more, hurting the consumer who's already struggling. It's a terrible bind. Fight inflation and risk crippling the government's finances, or keep rates low and let inflation keep hammering the consumer.
And the tools they usually use, they're kind of spent.
Largely, yes. The main tools they've relied on for decades, printing massive amounts of money, keeping rates near zero, they've pushed those about as far as they can go. Doing more risks, making inflation even worse, their ammunition is low.
And while all this is happening domestically, there's this other angle, the global picture, the U.S. dollar's dominance. It's not quite what it used to be.
No, that's definitely eroding. Having the world's reserve currency is a huge privilege, but that privilege is being chipped away at. We're seeing significant geopolitical shifts.
Like what specifically?
Crucially, the petrodollar system, that old arrangement where oil had to be traded in dollars, creating this huge artificial demand for dollars globally, that's fracturing.
Key oil producers are taking other currencies now.
Increasingly, yes. They're accepting payments in currencies other than the dollar. And beyond oil, you've got the BRICS nations, Brazil, Russia, India, China, South Africa, and others joining them, actively working on ways to trade directly with each other in their own local currencies.
Bypassing the dollar altogether.
Exactly. Trying to bypass the dollar as the middleman for global trade. And maybe the clearest signal, the ultimate sort of vote of no confidence. Central banks around the world are buying gold.
Physical gold.
At rates we haven't seen in decades. They're diversifying their reserves away from the dollar, clearly questioning its long-term role as the undisputed king.
Okay, so this global instability, the domestic policy trap, it all feeds into what sounds like the most complex and maybe dangerous part, the shadow financial system. The hidden leverage, the contagion risk. This is where things get really intricate, right? Where a problem in one corner can spread everywhere, instantly.
Absolutely. This is where complexity and hidden leverage create these specific ticking time bombs.
Yeah.
And they can connect, seemingly unrelated things, Wall Street finance and your everyday life almost instantly.
And you mentioned one specific mechanism that could be a trigger, something called the Japanese yen carry trade.
Yes. It sounds obscure, but it's potentially enormous.
Yeah.
It's fascinating because it connects what happens in, say, downtown Tokyo directly to the value of your 401k or pension fund.
Okay, explain that. How does this carry trade work and why is it so risky?
Well, the basic idea is pretty simple. Japan has kept its interest rates incredibly low, near zero, for decades now.
Yeah.
So big investors, hedge funds, banks, potentially even other central banks, borrow Japanese yen at virtually no cost. Then they convert that yen into dollars, euros, whatever, and use that borrowed money to buy assets that offer higher returns somewhere else in the world.
Like U.S. stocks, European bonds.
Exactly. U.S. stocks, high-yield corporate debt, emerging market assets, anything that pays more than the near-zero cost of borrowing the yen. It's essentially a giant global leveraged bet funded by cheap Japanese money.
Okay, but how big are we talking?
The direct trades themselves are estimated in the trillions, maybe $1 to $3 trillion.
Yep.
But the total exposure, all the investments around the world that are ultimately financed or influenced by this cheap yen funding, that could be closer to $20 trillion.
20 trillion. That's roughly the size of the entire U.S. economy.
Roughly, yes. It's a staggering amount of money, all balanced on one key assumption.
But Japan never raises its interest rates significantly.
Precisely. So what happens if the Bank of Japan finally does start raising rates, even just a little bit? Or what if global markets just get rocky for some other reason, making investors nervous?
The whole thing unwinds.
Violently, yes. If that trade stops working, everyone who borrowed cheap yen is instantly forced to sell their global assets, stocks, bonds, everything, often in a panic, to get yen back to repay those loans.
Which causes asset prices everywhere to fall.
Which forces more selling, creating this devastating, synchronized downward spiral across global markets. We actually saw a little preview of this back in August. The Bank of Japan made a very tiny technical adjustment to its policy, and global markets immediately plunged sharply for a few days. It was like a tremor before a potential earthquake.
Okay, so the yen carry trade is one potential trigger. But the contagion risk doesn't stop there, does it? You also mentioned commercial real estate, CRE.
Right. That's another major weak point. We all know office buildings, especially in major cities, are struggling. Many are trading at huge discounts, maybe fractions of what they were worth before the pandemic.
And that matters because?
Because there are trillions of dollars in loans backed by these buildings. If the property values collapse, the owners can't repay the loans. That leads to massive defaults, which hit the lenders hard, particularly regional banks, and also pension funds, which often have significant CRE investments.
So defaults there could ripple through the banking system and hit retirement savings.
Absolutely. And add one more factor: zombie companies. These are firms that aren't really profitable but have been kept alive purely by access to super cheap debt over the last decade.
Years of near zero interest rates.
Exactly. Fail at an accelerating rate. And when a zombie company goes bankrupt, it doesn't just disappear. It triggers a chain reaction.
Suppliers don't get paid, creditors take losses.
Right. The losses spread rapidly through the economy, hitting other businesses and lenders. It's all interconnected.
So just to recap the picture here, we have this convergence. Record government debt meeting historically extreme asset valuations, central banks running out of ammo, geopolitical tensions rising and fragmenting the global system, and then these specific, highly leveraged weak points like the yen carry trade and CRE just waiting for a spark. You're saying the adjustment, when it comes, won't be slow and orderly.
No, the speed is probably the most critical and perhaps least understood factor for most people. The adjustment, when it finally happens, is likely to be incredibly swift, violent, and frankly, merciless.
Why so fast?
Primarily because of how modern financial markets actually work. They're dominated by algorithmic trading.
Computers making decisions in milliseconds.
Exactly. These systems execute millions of trades per second, based purely on recognizing patterns and correlations in data. When they detect trouble, a sudden drop in one asset, a spike in volatility, they don't pause for human reflection.
No time for context.
None. They instantly sell not just the asset that triggered the alert, but everything else that their algorithms deem correlated with it, indiscriminately. It creates instantaneous, cascading sell-offs.
And the human traders, do they slow it down?
If anything, they amplify the speed. Think about fund managers. Their careers depend on performance relative to their peers. If a major sell-off starts, sitting on the sidelines while everyone else is selling is basically career suicide.
So they have to follow the herd.
The incentive structure almost guarantees it. Once significant selling begins, everyone piles in, accelerating the decline. It becomes a self-fulfilling prophecy, driven by algorithms and amplified by human fear and career risk.
And does the concentration of wealth play a role in this fragility?
Hugely. The fact that the top 10% of households control something like 67% of all wealth in the U.S. means that when markets crash, the impact on overall spending is disproportionately large and fast.
Because the wealthy lose a lot of paper wealth very quickly.
And they react by sharply cutting back on their spending, luxury goods, investments, services. That shock ripples down and cripples demand throughout the rest of the economy, affecting middle and lower income households almost overnight, even if they didn't have much direct market exposure.
And finally, what about the policy response in the middle of such a rapid crisis? Can governments or central banks step in effectively?
Well, that's another potential problem. The policy response itself is likely to be, well, incoherent, probably. You'll have political gridlock delaying effective action. Different countries might pursue contradictory policies, maybe renewed trade wars, or countries trying to devalue their currencies against each other to gain an advantage.
Which could just make the underlying crisis worse.
Potentially, yes. Instead of coordinated action, you could get policy responses that actually deepen the downturn.
So the historical lesson here seems pretty clear then.
I think it is. History consistently shows that complex systems, empires, ecosystems, financial systems that grow far beyond sustainable limits eventually, always, collapse back towards some kind of equilibrium. The mathematical realities haven't changed. Debt simply cannot grow faster than the underlying economy forever. Eventually, it has to be dealt with either through default, restructuring, or inflation.
In this convergence, we've talked about the record debt, the crazy asset valuations, the spent policy tools, the global fragmentation people will inevitably call the eventual crash unprecedented.
They always do. But it will only seem unprecedented to those who didn't study the clear precedents, the warning signs that were visible in the data all along.
So what's the final thought here, the takeaway for someone listening?
Well, what is perhaps unique this time around is the sheer speed and the intense interconnectedness of everything. Our modern financial systems are so tightly coupled, so dependent on global confidence that, as we've discussed, can just evaporate in microseconds thanks to technology. So when this incredibly complex leverage system finally snaps, the crisis probably won't unfold slowly over months or years, like maybe in the past. It could happen in weeks, maybe even days. So the central challenge, the question for you to really think about is this. What specific part of your own financial life, your savings, your job security, maybe your mortgage, your investments, what's most vulnerable if a major crisis unfolds not gradually, but at the speed of an algorithm? Understanding that vulnerability, that's probably the most crucial knowledge needed to navigate the system we actually live in today.